All right, Dubose Clinics has a target capital structure that calls for 25% debt and 75% common equity. If the bank charges Dubose 8% interest on borrowing, that's somewhat offset because of the tax savings. So if they're at the 40% tax rate, marginal tax rate, that means Uncle Sam will subsidize their capital raising because it's going to give them a tax break on the interest expenses. So we can easily calculate the cost of debt, and that is equal to the 8% nominal interest rate times 1 minus the tax rate. So the after-tax cost of debt, 4.8%. The cost of equity we can calculate using the capital asset pricing model. Let me throw some formulas in here. This is cost of debt equal to yield to maturity on outstanding debt times 1 minus the tax rate. And we can use capital asset pricing model in here, the cost of equity being equal to the risk-free rate plus the market risk premium times beta. Okay, so for our friends here at Dubose, if the stock market is earning 14% and treasuries are yielding 3%. Okay, so the risk-free rate is the 3%, and then the market risk premium would be the 14% minus the 3%. That's the 11% total market return over and above the 3% risk-free rate. And now we take the market risk premium for the average share of stock, multiply it by the beta for Dubose, and now I've got an estimate of the cost of equity. Okay, so I've got a cost of debt, I've got a cost of equity, I've got a target capital structure. Okay, so if I take the weight times the cost, and I just take a weighted average of those. Okay, so the debt, the weight is 25%, the equity, the weight is 75%, the cost of debt's 4.8, the cost of equity is 18.4, weight times cost, and then add them together. It's just a weighted average. So there is my weighted average cost of capital for this firm. Comes out to 15%.